What I'm going to present is an excerpt and a sneak peek of a larger presentation I'm working on the topic of systematic rules-based trading plan development. I'll be presenting the full trading plan development presentation to my systematic investors group community, but for those from the Ameribroker Canada user group community that are interested, they're all welcome to attend that presentation as well. What I'll probably do is just send out an invite to both lists. So this is an excerpt. This excerpt is focused on commissions and some useful things that can be done with Ameribroker in respect of commissions. So let's get started. Okay, now trading and investing, gang, can contain significant financial risk. So please take a moment to pause and read through the disclaimers in this presentation. I won't bore you with the disclaimers, but you can go ahead and look at them after. You can see we've got lots of disclaimers. Information provided for informational purposes only. Backtests are not necessarily indicative of future profits, all the things that you've seen in the past. So I won't bore you with all the disclaimers, but please just use all information at your own risk. Okay, so now let's talk about a few initial considerations with strategy commissions. So keeping commission costs in line is an important consideration for any trading plan. Commission costs become increasingly important as more active strategies are traded. So the more trades that a strategy performs in a year, the more the commission drag will work against a strategy. So it's not uncommon for systematic traders to get frustrated that they aren't achieving the results that they expect when too little capital is allocated to a strategy and commissions are proportionately high, effectively eating up profits. So the goal then should be to keep commissions as low as possible, especially when trading active strategies. So keeping commission costs to 10% or less as a percentage of net profit is ideal and should be the long-term goal. But it's not always possible when first starting out. So if you're just starting out, systematic trader might have to churn their account a little bit and pay higher commissions until they can either build up their account through trading activities or a combination of building up through trading profits plus adding regular installments from other sources like work income or savings or from other investments. So let's look at commissions based on Interactive Brokers fixed commission schedule. This is the, I believe there are two sort of major categories that you can subscribe to in terms of the commissions that you pay. I don't remember what the other one is called. I think it might be tiered pricing or something like that, but I know that I'm personally enrolled in the fixed schedule with Interactive Brokers. So commissions are half a penny per share with a minimum of $1 per order, which means per buy or per sell, or sometimes referred to as per side. So that would be, and then there's a maximum of 1% of the total trade value. So that's kind of the fixed pricing schedule. So when we talk about $1 per order, basically what you're looking at is like $2 per round trip, for buying and selling as a minimum. Okay, so here's how you can set up these conditions for the IB fixed commission schedule in Ameribroker. So if you go into the settings and you go into the commission table, the red highlighted sections are what you can fill out in the default commission table. So to be more accurate, you can calculate your strategy's conditions over the course of your backtest history. Okay, so we're going to look at commissions from two different perspectives. So the first perspective is just getting started, or snapshot in time, or just looking at it today. So what might commissions look like based on the capital I've allocated to my strategy today? That's kind of the question you're gonna answer. And the second scenario is when compounding over time. So what might commissions look like based on an amount of starting capital and then compounding those returns for my strategy over time? Okay, so first let's talk about a few initial considerations with commissions when getting started. And we're going to assume 20 years of trading with fixed or constant dollars. So for example, if you're trading with $20,000, you have 20 positions, you're always going to be trading with $1,000 allocation per position over the entire time period. Okay, so you generally only need to worry about commission costs when trading more active strategies. So this example uses our supercharged momentum trend strategy as an example, since it can trade upwards of 340 to 350 trades per year. So here are 4 scenarios starting with 20K, 33K, 50K, and then 100,000 per strategy. So we're trading a portfolio of up to 20 positions for this strategy. So our position size for each allocation will be different. And obviously this will affect the level of commission drag for each scenario. So in order to gauge how much commission drag there is for each allocation, we'll compare them by figuring out what commissions are as a percentage of our net profit. In other words, our total transaction costs divided by our net profit. So this analysis just represents a right now snapshot in time. If we were to use this amount of capital to start trading this strategy with 20 positions, what would our commissions look like? What would our commissions look like if we always use the exact same amount of dollars per strategy and per trade? In other words, with no compounding of position size. So as you can expect, higher strategy allocations have higher dollar starting position sizes per trade and therefore lower commission drag. In other words, as you increase the amount of capital allocated to each strategy and therefore each trade, the commissions as a percentage of profit go down. So when compounding your strategy and not using fixed or constant position dollars as we're doing here, the same will eventually happen, provided your commissions are not too high initially in order to allow your account size to grow. So as your account grows over time, each position size will increase, and therefore commission drag, measured here as a percentage of net profit, will actually go down. So let's look at what commissions averaged over 20 years, what that looks like using compounding. We'll see what that now looks like. But before we do, are there any questions about this slide before we move forward? So you can see here, like we've started with 20,000, we're trading $1,000 per position. We're not doing any compounding over the 20 years. So each position is using a maximum of $1,000 essentially. So all we've done is we've taken our total transaction costs, $14,071.57. We're dividing it by our net profit, which is telling us, if we're only trading with $20,000, our commissions are actually eating up 28% of our profit, which is pretty significant. When we start with $33,000, 20 positions, we're allocating $1,650 per position, and basically we're eating up about 16.3% of our profit, which is still pretty significant, right? So under these scenarios, if you have a profitable strategy, you're typically growing your account slowly in the beginning of your backtest period or your real trading period, and you're making your broker a lot of money. Okay, now if you start with about 20,000 or rather 50,000, and you have a position size of about $2,500, you can see that your commission drag or your commissions as a percentage of your net profit drop down to about 10%. This is about generally what you want to see with an active strategy, 10% or less, so that you can start building your account and your expenses aren't too high. Now, if you start with $100,000, in this case, you've got about 5,000 per position, and your starting expenses are 6.7% of profit. So I think that's the calculations aren't too difficult. I'm sure that makes sense to everybody. I don't see any questions coming through, so I will keep moving forward. So now let's look at commissions when averaged over 20 years. The commission drag at the beginning may be high depending on the strategy allocation, but it goes down as the account grows. So we can see here that eventually commission drag will come down over time as we compound and our strategy allocation and therefore position size increase. Our position sizes increase. So it looks reasonable here displayed as an average, but in the beginning, commission drag can be a real challenge to overcome and can cause slow initial account growth, which is why we looked at what commissions would cost if we were to start at specific allocation dollars and stay at those exact allocation dollars using fixed dollar position sizing. So this is one big factor that really determines how much you want to allocate to each strategy initially. So if commission drag is too high from the start, there's a few things that can be done. So for example, we can start with more money per strategy or use less strategies to start so that there's more money allocated per strategy and therefore per position. Another option we have is we can start with less money per strategy, but regularly add more money into the strategy each month from another income or savings source until we sufficiently build things up, kind of like contributing to your RSP every month on a regular contribution plan. Or we can cut down on the number of positions being traded for that strategy so that each position size is relatively larger. But we need to recognize that this may affect our strategy metrics and our risk, specifically our level of drawdowns going forward. Typically, when you use less positions per strategy, your drawdown will increase. Now, that's kind of a general rule of thumb. So as mentioned earlier, a good rule of thumb should be to try to keep active strategy commissions to 10% of net profit or less where possible over the long term. It may not be possible in the immediate or short term, so it can be a bit of a balancing act in the beginning stages. So are there any questions about this slide or the calculations before moving ahead? So you can see here, even though we started with $20,000, we're compounding our returns, and over the course of like in the beginning, it will be about 20% represent about 20% of our profit, but over the long term, it ends up being about 6.7% of our profit with an active strategy like this. And with $33,000 starting, it ends up being just under 5%, and then it drops to 4.5, and then 4%. So we start to slow down around the 4 to 5% cost range. I think I've seen some strategies drop down to like maybe 3 or 4%, but I haven't really seen them much lower than that based on some of the numbers we've been using. Okay, so I don't see any questions coming through. Or do I? Let me just see here. Nope, I don't see any questions coming through. So I'll keep it moving. Okay, so hang on a second, gang. It's funny because on my one computer, I see, okay, Ebert says it's very clear, thanks. Okay, so on my one computer, I can see things coming through just the notification, but I don't see anything coming through the chat. So hopefully that's not an issue with my computer. Okay, so okay, gang. So if there are questions coming through that I'm not seeing, I will I'll catch them at the end. So here's the code for those that want to play around with compounding versus non-compounding, or if you want to determine what your commissions look like right now with a certain amount of capital allocation for a specific strategy versus over time with the effects of compounding and growing your strategy allocation. So this code's also useful if you want to run an all trades type of backtesting scenario. So in other words, you can set compounding to no, and then you can use, for example, 1,500 for the number of positions and set the initial equity to like 1.5 million or whatever numbers make sense for the strategies you're working with, so that the backtest takes every single trade signal that is absolutely possible. So from this, you can get some different insight insofar as how well your rules work when taking every signal available. So are there any questions about the code before we move forward with the last slide? Let me maybe just try and be a little bit more clear about that. So I'll also post the code with the recording, or you can grab a screenshot of it now, or you can grab a screenshot from the recording. But essentially with, we kind of covered what you can do with just looking at getting an accurate picture of what your commissions will be, today, depending on your starting equity, and then what they would be on your starting equity looking over the course of a back test with compounding. But with an all trades test, another thing that you can do with this code, if you just select no compounding, is you can just capture every single trade, right? So some of the metrics will be useful and some of them will not. So okay, so I mentioned that it can be useful looking at some data from a back test when there's no compounding, and the back test represents every single trade signal taken. So metrics like CAR, compounded annual return, and CAR MDD, or CAR over MDD, or your MAR ratio as it's sometimes referred to, they become pretty meaningless with the null trades type test. However, the visual of your equity curve as well as your expectancy percentage are really, really quite useful and really meaningful. So here is your essentially your expectancy percentage, and as you can see, your equity curve. So this type of analysis will essentially tell you if your rules have a stated edge, given that you have a positive expectancy percentage if you were to take all available signals. So in this example, our expectancy is 0.77%, which is denoted beside the blue arrow. This means that on average, between our winners and our losers, we make about, just under 1% per trade. So you want to make sure that your expectancy percentage per trade is high enough so that market action like slippage probably won't turn a winning strategy into a losing strategy during real world trading. Now, as well, one of the things we do is a lot of times with our strategy, if we're not using limit orders, we'll use market on open or market on close orders, which get executed in the opening and closing auction process, so that the results are pretty accurate and you don't really get slippage in your back test. But sometimes market action can cause some slippage. So you essentially want to make sure that your expectancy percent is high enough to absorb your costs, right? Or any slippage or any unforeseen costs. And the other thing you want to you essentially want to consider is that if your expectancy percentage is high enough and you have enough trades, you basically want to, you've got statistically significant number of trades here. You have 7,007 trades or instances, and you can see like the useful information is, like if you were to perform exactly all the trades, what is your expectancy? That can be useful over top of just the trades that you've taken in your back test, right? A lot of times what I'll do is I'll look at the trades that I've taken in my back test, which is a portfolio level back test, and see if my expectancy, if I were to have taken every single trade, if I still have a positive edge. Okay, so that's kind of what you're looking at there. So the equity curve also shows you how well it performed in the past, and hopefully how well it might perform going forward. So of course we want a curve that moves from left to right in an upward fashion as consistently and as smoothly as possible. Other metrics that may be useful in the all trades tests are the total number of trades, to make sure that we have enough trades so that our test is statistically relevant, as I mentioned here. We want to, of course, look at the expectancy to make sure that it's in line. We have a positive expectancy. The win rate and the win rate here, the loss rate here, they give you an indication of how often your strategy might be wrong, right and wrong in live trading, as well as maybe you want to look at your profit factor and your payoff ratio. But a lot of the other metrics kind of become, some of them are useful. Like you can see, you've got your maximum number of consecutive wins. You've got, your average profit per trade, your average loss per trade. Those are useful. But things like your compounded annual return become kind of useless because you're not utilizing your capital efficiently because you're not compounding. Your car MDD obviously is pretty useless. So some of the metrics, you just kind of have to be careful when you're looking at the test in different ways, that you're looking at the metrics that actually make sense for the type of test that you're looking at. If you're doing a portfolio level back test, well, then most of the metrics are, valid. But when you start doing things like this, where you're modifying your inputs, some of the metrics just don't really help, or they just don't actually have any context for the type of trade that you're doing. Okay. So I'll let me just have a quick drink and I'll take any questions that you guys have. Now, I hope I didn't lose any context in there. Like I said, this is part of a larger presentation on how to develop your systematic trading plan and put it together. This was just one kind of excerpt or chapter in that larger presentation. And actually, you got the ME Broker Canada user group got a sneak peek at it. And one of the reasons was I wanted to share something with the group. And I also want to see if it kind of all makes sense. So I wanted to get a little bit of feedback on it as well. So let's see here. Let me just pull this up on my computer that is closer to me. So just give me a second to wrangle my screens here, gang. Let's see, where is my... Okay, participants. Okay, so Jim says, correct me if I'm wrong, but is it my understanding of the following? In Canada, most Canadian brokers have $5 to $10 per trade charge. The smaller positions get killed with a high fixed cost or with volume. The variability in at market entry, exit, slippage is poor. The opportunity cost associated with using them versus interactive brokers is very significant. Opportunity for enhanced trading is maximized with IB in Canada. Yeah. So so Jim, the rates that I'm looking at are not. They're for the U.S. market. I didn't look at. I don't know if the rates are the same for the Canadian market. I currently don't do any active trading in the Canadian market, so I'd have to look into that. But I would suggest that, yeah, if you look at the cost of your trades on average, your minimum price is going to be with interactive brokers about $1 per side or $2 per round trip, per round turn. So if you're trading with $20,000, for example, you can see here, if you're trading with $20,000 and you've got $1,000 per position, that $2, that minimum $2, already represents about 28% of any profit that you make. So as you can imagine, if you're paying $5 to $10 per trade and you're doing active trading, you're probably going to destroy your trading account. If you're going to do that kind of trading, you probably want to do, less active trading where maybe you're doing trend following or something like that. I think when you're doing active trading, at least with interactive brokers, now you have to see, this is part of the trading plan process, and part of the thing that I'm trying to impress upon my members in the presentation is that you have to look at what your commission costs are and how active your strategy is, and you have to figure out what the commission drag is so that you can either figure out if you're paying too much in commissions, how you can lower those commissions, or if maybe you need to start trading with a little bit more capital per strategy. I think the sweet spot is maybe starting with about, 33,000 to 50,000 per strategy. And then that way, at some point you'll build this up to 50,000, and you'll get your commissions down to about 10% or less. So I think that's kind of the sweet spot. You can, like, I've started trading strategies with 20,000, and what that does is maybe what you want to do is regularly add a little bit of money into your account, and you want to compound your results. So it's going to be a little bit, the drag in the beginning is going to be a little bit harder. So you might want to maybe, cut down the number of positions, etc. But yeah, I would say, Jim, that if you're trading with a minimum of $5 to $10 per trade, per side, I mean, that's going to add a lot to an active strategy, right? I hope that answers your question. So Rick says, so would it be better to backtest the system? Would it be better to turn compounding off? Well, what I do is I do both. So usually what I do is I just run normal portfolio backtests using compounding. But at some point, what I do is I kind of I'll turn the compounding off just to see what my equity curve looks like. And I want to see what my expectancy looks like compared to my portfolio backtest. Because at the end of the day, the thing that is important is that you have a positive expectancy for your backtest. So if I want to know what the efficacy is of a trading signal or trading rules per se, sometimes what I want to know is if I just took every signal available for my universe of stocks over a 20-year period, does the strategy actually work, or is there a component of signal luck? Nick Raj talks a lot about signal luck, where sometimes you can get, you were just lucky in the order of signals that you received. Maybe your ranking algorithm helped you out. So I want to know if my raw rules actually have a positive expectancy. So sometimes what I'll do is I'll try and figure out what my commission drag is by turning the compounding off and just looking at what I'm allocating to that strategy today. But what I'll also do is I'll look at, all the trades, and I'll look at the expectancy, and I'll look to see if the expectancy is close to what my portfolio backtest is, in which case, maybe my backtest isn't a matter of signal luck. Maybe I have a more robust strategy, and just, the average of trades over a given set of trades, maybe 100 trades, is going to average out close to what it normally would if I were to take all trades. That's kind of what I'm wondering. So to answer your question, Rick, yes, it is better to not only do normal portfolio level back testing with compounding, but also to look at it from the perspective that I just kind of tried to explain there. Larry says, great topic. Thanks, Larry. Appreciate that. Ebert says, thanks. You're welcome. Jim, thanks. You're welcome, Jim. Blair says, good topic to get people thinking about. Absolutely. Blair, when I started systematic trading, like, I'm running 3 or 4 strategies at any given time. And I've noticed that some of my strategies were doing well, but I didn't have enough money allocated to some of my strategies. So the broker was getting rich, but even though the back tests were showing that strategies were doing well, my account wasn't growing that much. So what I decided to do is figure out, okay, how do I actually look at putting my entire trading plan together, and how do I look at how much to allocate to every strategy based on the fact that some are more active, some are less active. There's going to be more commission drag on some versus others. And so I'm kind of retooling my entire trading strategy and my allocations. And that's just, things that you learn through experience and kind of burning while you learn. So Ebert says, so Bruce says, thanks to all 3 presenters. Some good ideas worth considering. Thank you, Bruce. I agree. Excuse me. Ebert says, have to keep commissions in mind. Absolutely. JM says, great topics tonight. Thank you, JM. Jim says, Dave, you mentioned by using market on close or market on open, that slippage is reduced. Does this hold for most strategies? Yes. So typically a lot of my strategies that I use and that we actually offer through Systematic Investors Group or that I just personally backtest, a lot of times what I do is I look at either buying on the open or buying or selling on the close or vice versa. A lot of times I'll use the opening auction. And you'll notice on a chart like that's where the big spikes are. And that's why, because a lot of people place their orders overnight. But the good thing about the market on open orders and market on close orders is that if you've got a decent charting software like AMI Broker using Norgate or Metastock data, the opening price that you see on a chart or the closing price you see on the chart is basically what you're going to get filled at when you're using real-time market on open and real-time market on close order. So that really helps you align your back test with your trading strategy, as opposed to like just throwing a market order out there and not knowing exactly where you would have gotten filled in the real world. Your back test and your real world results should line up very, very nicely. And just for, just as a practical point, it's just really easy to use those type of orders for back testing and for real world trading. Okay, so Marcel says, does anyone trade Canadian stocks with Interactive Brokers? The commission can be excessively high if you try to buy small price stocks with thousands of shares. I haven't found a workaround for that. So Marcel, what I would suggest is talking to them directly and seeing what pricing plan you're on. As I mentioned, I'm on the fixed pricing plan. And I think some of the other systematic traders I work with, I want to say maybe Gary B was telling me this, but I don't remember exactly who told me this. But sometimes what they'll do is they'll trade low price stocks with a fixed, another broker that is fixed, has fixed dollar per no matter how many trades. Like Jim had mentioned earlier, you pay $5 or you pay $3 or $10 for the entire trade. Sometimes it's cheaper to do that. The other option might be just to talk to Interactive Brokers and see what schedule you're on and if that will affect your commissions. Let's see. So Doug D says, what provision is made for tax? Doug D, absolutely no provision is made for tax because everybody's tax situation is different. And I think it would be actually very difficult to, I've never really thought this through, but just off the top of my head, I don't think you can really make much provision for tax in your back test. What you probably need to do is just look at, what your profits were at the end of the year, at the end of each year, how much you have allocated toward it, and then looking at, what your tax bracket might be. And what you might have to pay for taxes. I think a lot of people that do a lot of trading usually have their trading in a corporate account, and then what they'll do is they'll just do their taxes that way and maybe pay themselves a dividend or just leave the money in there and have a preferred tax rate with their corporation. Everybody's situation is different, so you kind of have to assess that based on your own trading plan and speaking with your your tax consultant. So I hope that helps, Doug. So Blair says, Dave, your strategy is very active with about a trade per day. Yeah. So that's one of the free strategies that we offer, Blair, through Systematic Investors Group. I actually trade it with real money. The results have been pretty good. Actually, I can show you what, just quickly. I can show you what the results look like. So here's a list of the strategies. If you look at the, where is it? Supercharged momentum trend here. So here's the back test of the historical results. And if you look at the charts, this is how it's performing. Here's its equity curve. And here's its profit table. So the last 3 years, it's actually performed pretty decently. And this year it's actually doing quite nicely. So this is one of the free strategies that we offer. And we actually post the signals every day. If you look at, here's the visual of the strategies, but we also have so here's like what the signals look like every day. So you can see, if you had an empty portfolio, you would have gotten all these signals today. that went off yesterday but were actionable today. And then these are all the things that would have been sold if you had them in your portfolio. And then we also offer it in a Alera Portfolio Manager ready format so that you can just, for example, just trade it like this. Wait a second. This is a paper account that I have trading it, but I'm also trading it. I'm also trading it in my live account. Let me just see here. Yeah, so this is the paper trading version running. You can track the P&L, so you can see here it's not performing as well as the just the SPY over the year, but this has been running for about 190 days using about this allocation, 115K, and it's up about 24% over 190 days. So, I mean, it's hard to beat the SPY when it's been going up the way it has, but over the long term, it definitely does beat the SPY. So yeah, so the signals are available, as an APM ready format. So it'll just, it'll just trade it and it'll just manage your portfolio. So this is kind of what the portfolio looks like, this portfolio right now, based on that. Okay. So sorry, I got a little bit sidetracked there. But yeah, Blair, it is pretty active. I think it trades about 340 or 350 stocks a year, individual positions. So Thelg, sorry, I can't remember what your full name might be. So Thelg says, so from your presentation statistics, why would anyone choose Interactive Brokers to trade with when they can trade commission-free with other brokers like TD, Ameritrade, or Fidelity? Okay, so that's kind of a loaded question. So the first reason is that Interactive Brokers has a good API for algorithmic trading. So for example, the software I just showed you, Alera Portfolio Manager, which I use, and I actually, in my other business, I help promote them and I help market their software because I believe in it and I love their software. But that will connect directly to Interactive Brokers. TD Ameritrade and Fidelity don't necessarily have the capability to trade in an automated fashion. So that's one of the reasons. The other reason is that whether you're paying commissions up front with your broker or not, you're still paying commissions. So what I mean by that is a lot of people believe that they're actually getting commission-free trading through a lot of brokers like TD Ameritrade, Fidelity, or Robinhood. And the fact of the matter is that what they're doing is they're selling your order flow to companies like Citadel and to other kind of quasi market makers and high frequency algorithmic traders that are basically matchmakers, for lack of a better word. Inadvertently, you are paying commissions because what they do is they front run your orders and they typically mark them up a little bit. So I mean, if you're not actually seeing commissions being traded, then they're typically selling your order flow and you are inadvertently paying commissions through higher costs of transactions, either through slippage or through front running, essentially. So, I mean, I would rather pay commissions directly that are reasonable, track what my commission costs are, and know that my broker is not selling my order flow to companies that are going to eventually figure out ways to game my strategies, essentially. Rick says, thank you to all. Welcome. Howard says, thanks, Marcel, Larry, and Dave. Thank you, Howard. And thanks for joining us. I appreciate it. We'll look forward to your presentations in the near future as well. Let's see. Dave, thanks for, our host says, Dave, thanks for clarifying why and when not to use compounding. But when live trading, one would actually let compounding dictate the trade size, right? Yeah. So for example, like I said, I use Alera Portfolio Manager in my live trading, and it will automatically calculate what my position size should be based on my live net asset value of my account. So as my account grows, it automatically increases my position sizes accordingly, depending on my allocations. And conversely, if I'm in a drawdown, it will decrease my position sizes for future trades accordingly, so that it maintains the equal weight position size, depending on um, how much I have available in my account. So I suggest trading that way. That's how I trade. I think it's really useful. Increasing and decreasing your position sizes as your account shrinks and grows is probably a good practice. I personally do it myself. Other systematic traders I know do it as well. Marcel says, great presentations, Dave and Larry. Thank you, Marcel. Great presentation yourself. With larger stocks, I'll risk market on open orders. With smaller stocks, I'll typically set it for limit on open, limit plus 1%. Yeah, that's a good way to do it, I think. One of the things that I know a Layer portfolio manager does, Marcel, and I'm mentioning this because I know you use a Layer portfolio manager, is you can use something called protected orders. And what that'll do is it'll allow you to put that 1% in there, and it will manage it. So it'll basically spit out the order to market, or market on open, and then it will change it to a limit order so that it doesn't allow it to get sold over whatever percentage you set, to account for that kind of slippage. But it will do it automatically so that you don't have to mess with it. So if you're not sure how that works, you can reach out, to myself or Dan or Alex, Alex directly at Ameritrade. He can explain to you exactly how to do that. Gary B. Hey, Gary, good to see you online. So Gary says, I will use CIBC, Investor's Edge, or Questrade to trade lower price stocks. IB for more expensive US stocks. Yes. So it was you, Gary, that explained that to me. So gang, it was Gary that explained that to me. I tried to explain that earlier. That's what Gary does. I only trade highly liquid stocks. So, I just maintain one brokerage account where possible. And I use interactive brokers for that.